Welcome to the latest edition of On the Economy, live interview version. I'm here once again with the Center on Budget and Policy Priorities tax analyst Chye-Ching Huang, who's just written a great and important paper I've highlighted on the blog already. Start by telling us, Chye-Ching, what the paper found in broad terms.
So we look at two things, Jared. We look at the behavioural responses of high-income taxpayers to tax increases. So how their behaviour changes when taxes go up.
Now, by behaviour, do you mean specifically what?
Well, things like whether they work less, whether
I have
they
young
save
kids.
less.
When I think of behaviour, it's like, are you going to bed on time? But that's not what you're talking about.
So working, saving, entrepreneurship, those sorts of things.
Stuff that matters to the real economy.
Yeah, so there's that side of things. And we find that on the whole, there's no sound evidence that raising taxes modestly at the rates that are being considered at the moment actually has any significant or harmful behavioural responses that would harm the economy.
Okay, so let's drill down on that, because that is a key finding, and not just obviously in Chye-Ching's work, but for policy debates that are highly relevant right now. So you're saying a modest increase on tax rates at the higher end of the income scale wouldn't have the behavioral effects that would negatively affect the real economy. Are we talking about something like the sunsetting of the high-end Bush tax cuts,
right,
which would take the top rate from 35% to 39.6%?
Is that? That's right. That's
okay.
Right. So what the studies find, for example, is that you hear that if rates raise for high-income people, they'll work less and they'll go to the beach. That's the sort of thing that you hear. But these studies show that, in fact, the responses at the top of the income scale to tax increases in terms of hours worked is actually very, very small on average.
Okay.
And the thing is that some people might work less because what they're getting paid after tax does go down, but others might work more because they might have a certain savings goal or want to have a certain amount of after-tax income.
Okay, I got it. So for the microeconomic aficionados listening to us, Chye-Ching was just describing the substitution effect, which says you'll work less if your taxes go up, versus the income effect, which says you'll work more because you're trying to target an income level. So Chye-Ching, in this debate, what we often hear, and I've written about this a lot on the blog under the rubric of small responders versus large responders. In this debate, we typically hear quite a different finding. One that says if you tweak tax rates one way or the other, you'll have really huge behavioral responses. Speak to that issue a second.
Well, the thing is that some groups do respond quite significantly. So if you look at the research on second earners in the household, for example, or people that are close to retirement age, their responses to tax rates are quite a lot larger than what we find for people at the top of the income distribution. If you're looking at that group, though, in particular, their responses are negligible.
Now, one of the things we hear in the context of this debate is what we really ought to do is lower the tax rates and broaden the tax base so that you could have revenue neutral tax reform. That is, you'd have a lower rate, but because you'd kick off, I guess, these better responses, and because you'd broaden the base, you'd be okay on the revenue side. What do you think of that?
Well, the attraction of broadening the base, which means cutting out some tax expenditures, spending through the tax code.
Give me an example of a loophole or a tax expenditure.
Tax expenditure. So a lot of these things are deliberately put in the tax code. So things like the mortgage interest deduction, that incentivizes people to perhaps spend more on houses than they otherwise would.
Which I think amounts to about $100 billion a year in terms of foregone revenue.
These things are significant.
Okay.
So you could generate revenue by limiting these things, and you'd also make the tax code more efficient because people aren't organising their behaviour around getting these tax breaks.
Okay.
So for that reason, people want to broaden the base as much as possible and have as low rates as possible to achieve the revenues needed. And all else being equal, that's a really good way to go about tax reform. But in the current situation, we need more revenues to contribute to deficit reduction. And there's a number of reasons to think that you couldn't do that all from just base broadening. First of all, the revenues that we need are very significant. Secondly, a lot of these tax expenditures are very politically difficult to reform.
Right.
And some of them do serve really important needs as well.
So this is, when I hear people say, lower the rates and broaden the base, I often go to the place you just went, which is to say broaden the base sounds a lot easier than to actually broaden the base.
Right.
Because a lot of these are politically beloved, tax expenditures. So if we take your findings and try to think about their implications for public policy, recently there was a paper by Emmanuel Saez and Peter Diamond that said, in fact, you could raise tax rates on high income earners, quite significantly, and not have negative effects. Am I interpreting that correctly? What was, and how high would they go?
Well, they're looking at a couple of things. So the revenue maximising rate. So the idea is that as you raise rates, people might report less taxable income, and therefore at some point, if you raise the rates, you're not actually going to get any more revenue back from it because people will report so much less income. And they point out that this revenue maximising rate...
Tax avoidance, is that what we're describing here?
Right.
Tax avoidance, yeah.
And they point out that revenue maximising rate is far, far higher than current rates.
Right, so they're somewhere in the 50% and up range, right? Mm-hmm. So if we could take then what they said, what you found in your paper, looking at, how much evidence did you look at, by the way? I think you went back pretty far.
Right, so we looked at 5 different channels through which taxes are said to influence growth. So
work, savings, entrepreneurship, small business. I know you looked at investment, like your capital gains. So in every one of those channels you found a similar thing, which is that tax increases of the type that we're contemplating now likely would not have the kinds of
right.
effects.
So on the behaviour side, those effects, there's no good evidence that those effects would be significantly harmful to economic growth. And that's just one side of the story, of course, because taxes don't just have behaviour effects, they have effects on the government's books. So the revenues that you get from raising revenues can be used to pay for significant investments that are needed to support growth, infrastructure, education, and they can be used to pay down the deficit. And
this is a very important, let's stop here for a second. All of the discussion about taxes is all costs, no benefits. You're now introducing something that is, I think, under-discussed and underappreciated. There are benefits from things that we finance through our tax code that, and I'm not just talking about sugar candy for various interest groups, but things that redound to the nation's productivity, to kids' education, things like that.
Right, and particularly in this context where people are looking to reduce the deficit, that can have a good long-term impact on growth, reducing the deficit. It increases national saving, it makes the long-term cost of investment lower. So as a whole, that sort of deficit reduction package could be supportive of growth rather than hurting it.
All right. Well, thank you for sharing those findings with us. The paper is linked on our site, and check it out. It's a great read. Thanks, Chye-Ching.
Thanks, Jared.